Many investing philosophies are being put to use in the stock market. We see pretty much everything ranging from strategies like contrarian investing, dividend investing, social responsible investing, diversification, dollar cost averaging, momentum investing, 60-40 investing, growth investing, shorting stocks, and so on. The list is a big one, but one common mistake that many investors make and end up losing their money is that they rush their decisions and are entangled in the lust of making some quick cash. This strategy may prove fruitful in the short term, but an amount of $10,000 is surely not better than $100,000 or even $1 million in the long run, right? Today we're going to talk about the philosophy of the billionaires like Warren Buffett, Bill Gates, Jamie Dimon, Peter Lynch, Robert Kiyosaki, and many more. In this video, we're going to bring forward the benefits of the buy and hold strategy, as well as the setbacks of ignoring this strategy. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. Every investing strategy has certain strengths and weaknesses. Where the permanent portfolio gives us impressive consistency and tranquility, growth investing gives us great long-term prospects, and the 60-40 investing strategy provides the classical balance. But today, we're going to be looking at what some billionaire investors have called the ultimate buy and hold strategy. In simpler terms, the buy and hold strategy simply means that you're staying invested for a long period. That also means that customary market crashes should not put you off, and you're actually staying invested for years or even decades. Now, this strategy can help you avert many knee-jerk reactions, which could actually have a devastating impact on your annual returns. This strategy is a passive investment strategy, and if you're following this strategy, that means you're holding onto your stocks regardless of what the market situation is. According to John C. Bogle, the founder and chief executive of the Vanguard Group, and also credited as the founder of the first ever index fund in the stock market, said, "Buy and hold is eternal." And truth be told, there's a good reason for that. He was probably one of the greatest investors known to the investing world. Now, Jack Bogle has left his legacy revolving around buying and holding stocks for the long term. This is the reason he said, "If you hold the stock market, you will grow with America." He helped thousands and thousands of people by introducing them to an investing strategy that defined a generation. Now the trend tells us that investors employing this particular strategy tend to outperform the active management and that they're making significant returns in the longer run. And to put the cherry on the cake, they're also getting advantages when it comes to the capital gains taxes. We all know that when we're buying a stock, we're actually buying into that company. Suppose you're buying some Apple AAPL stock. Let's say that you bought 100 shares of Apple stock. Now, if you bought 100 shares at the closing price of $18 per share in January 2007, and despite certain deadly fluctuations where you saw many of your peers getting rid of this stock, you decided to hang on until 2018. Now you're looking at Apple stock worth $157 per share. That's an astonishing return rate of more than 900%, whereas your friends who decided to pull out of this stock are still trying to make some money by investing in some startups, ETFs, bonds, and other real estate assets. When following the buy and hold strategy, there's no intention of selling the stocks in the short term. Investors mostly follow and rely on fundamental analysis when using this strategy. The analysis mostly includes factors like the previous performance of the company and its long-term growth strategy. Now let us understand how buying and holding stock for the long term actually works mathematically. Assume that Mr. X is having a total of $500,000 to invest in different companies throughout the stock market, and he is actually trying to find some quality stocks so that he can enjoy great returns. But seeing the market conditions, which according to Mr. X weren't favourable to invest all of his money, he decided to invest 50% of the money in stocks, 20% in bonds, and the remaining 30% goes into some other asset classes such as real estate and government-issued bills. Now, after a tenure of 2 years, due to some policy changes by the Federal Reserve and some great macroeconomic conditions for business, there's a sharp rise in the value of stocks in which the principal investment was made. The weight of the stocks rises in the portfolio from 50 to 75%, and the investment in other asset classes is reduced to 10% and 15%. Now this situation is confusing Mr. X. Should he maintain the original ratio of 50% in stocks? For that, he has to sell some of his stocks. And should he cash out? Should he enjoy the leverage of some quick money? Now, if Mr. X decides to sell the stocks, he is not sticking to the principles of the buy and hold strategy. Contrary to the above situation, if Mr. X refrains to interfere with his stock position and lets them grow, or he ignores all of his friends, relatives, and financial advisors on his favorite podcast who was emphasizing rebalancing the portfolio, in this case, he is holding onto his stocks and hence following the buy and hold strategy. After all, he finally decides to go with the buy and hold strategy. Actually, he was fortunate enough to hear about the Oracle of Omaha and the chairman of Berkshire Hathaway, Warren Buffett, who stresses that the money is made in investments by investing and by owning good companies for long periods. They're going to do fine 10, 20, 30 years from now. And on another occasion, Buffett emphasizes that if they're trying to buy and sell stocks and worry when they go down a little bit and they think they should maybe sell them when they go up, they're not going to have very good results. Mr. X now believes that he is way busier to start the short-term market fluctuations, and in July 2013, he worked hard and saved some $2,300, which he invested without any hesitation in Facebook stock. So in July 2013, the closing prices of this stock were around some $23 per share, and by doing some basic math, we can certainly know that Mr. X actually got his hands on 100 shares of Facebook stock. He was determined, to say the least, and he held the stock for 11 years. Finally, he sold these shares in July 2019, and to his pleasure, now the stock prices were lurking somewhere around $204 per share. Now, we need to observe that the rate of returns over here is great, and Mr. X has got $181 more per share. The holding period was a long one, and the returns were extravagant, even more than 786%. This is what the buy and hold strategy is all about. It worked efficiently for Mr. X. It can also work for every value investor if they invest their money in the right way and stop depending on the old and weary methods of investing in the stock market. Now, the important truth to be highlighted over here is that the transactions made are very low in the case of strategy revolving around the buy and hold. This ultimately means less brokerage fee and sales commission, and interestingly, when we're holding the stocks for the long term, the capital gain is also applicable, providing us with an advantage on taxes. Furthermore, this strategy requires only one-time appropriate stock selection, and that is very important. This is the reason we've provided you guys with the free ebook in the comments section below, which will explain the 6 stock categories and will be pertinent in your journey to financial freedom. Check out the video we handpicked for you, and we'll see you in the next one.